Behind every dollar, there's a story. Welcome to the world of finance. Plu, Uncovered.
Join me as I dive deep into the mystery of what really caused the market crash on Black Monday 1987. Black Monday, October 19, 1987, is a day that will forever be etched in the annals of financial history. On this day, stock markets around the world experienced a catastrophic crash, with the Dow Jones Industrial Average plummeting by over 22% in a single day. This event sent shockwaves through the global economy, leaving investors scrambling to make sense of the chaos. The immediate consequences of the crash were dire. Stock prices tumbled, wiping out billions of dollars in investments. The fear it instilled in investors was palpable, with many wondering if the very foundations of the financial system were crumbling. As the day unfolded, panic selling intensified, and the market's volatility reached unprecedented levels. The confusion surrounding why this crash happened was only matched by the speed at which it occurred. In the days and weeks leading up to Black Monday, several factors had been building in the background. Economic conditions were shifting, with rising interest rates and a strong US dollar making it more expensive for companies to borrow and invest. The increasing use of computer trading systems and program trading was also changing the landscape of the stock market. Many investors were caught up in the excitement of the bull market, and a sense of complacency had begun to creep in. The psychology of investors also played a significant role in the lead-up to the crash. As stock prices continued to rise, more and more people jumped on the bandwagon, eager to get in on the action. This created a self-reinforcing cycle, where rising prices fueled even more buying. But beneath the surface, tensions were building, and the market was becoming increasingly vulnerable to a correction. The key insight that illustrates the main cause of the crash lies in the role of program trading. These computer systems were designed to automatically buy and sell stocks based on certain market conditions. On Black Monday, they exacerbated the sell-off, creating a vicious cycle of selling that was almost impossible to stop. As stock prices began to fall, these programs kicked in, selling stocks and futures in massive quantities, which in turn accelerated the decline. The impact of program trading was compounded by the fact that many investors had taken on large amounts of debt to buy stocks, using a strategy known as portfolio insurance. When the market started to fall, these investors were forced to sell their stocks to cover their losses, further fueling the downward spiral. This combination of program trading and portfolio insurance created a perfect storm that ultimately led to the crash. The crash of 1987 had a lasting impact on market regulations and investor behavior. It led to significant changes in the way markets operate, including the introduction of circuit breakers to halt trading in times of extreme volatility. The event also served as a sobering reminder of the dangers of unchecked speculation and the importance of prudent risk management. The memories of Black Monday continue to influence investor decisions to this day. If you have any thoughts on what caused the market crash on Black Monday 1987, I'd love to hear them in the comments. If you're interested in learning more about market trends and historical crashes, be sure to check out my video on the dot-com bubble and how it burst.